right, everyone. It is officially 2 p.m. Eastern, so let's go ahead and get started with today's webinar. First, I do want to thank all of you for taking time away from the first day of March Madness to join us for this webinar. I hope whatever Buffalo Wild Wings you are dialing in from has really good Wi-Fi and a clear angle to the TV so that you can keep an eye on both. We do promise that this will be worth it though, so thank you for joining us. Just a couple of housekeeping issues before we begin. This webinar is recorded, and we will be sending the recording and the slides around tomorrow in an email to all of our attendees and absentees. So if they weren't able to make it, you will get the recording. Also, once you get it, feel free to forward it to any of your colleagues who were maybe too busy watching basketball games to hop on today. We are also happy to answer any questions you might have. So if anything comes up during the presentation, you can use that Q&A box that's located in the bottom bar. Submit your question and we will address it at the end of the presentation. All right, we have a jam-packed agenda today, so let's go ahead and get started. First, we'll begin with speaker introductions. I am Taylor Britt, Senior Director of Marketing for the Difference Card. I've been with the organization for 9 years now, and my job is putting on fun webinars like this. Josh, how about you?
Yeah, thanks, Taylor. Josh Pyzik. Hi, everyone. I'm the Director of Sales for the Midwest and West markets for the Difference Card. Been with the company for 12 years and work closely with senior consultants that you may know, really stretch from Pittsburgh, Pennsylvania, all the way out to California. So happy to be with you today, and I'll pass it to my colleague, Ashley.
Great. Thanks, Josh. Good afternoon, everyone. My name is Ashley Doobie. I am Josh's counterpart of the East. So I manage a very talented team all the way from New England down to Florida on the East Coast. And I've been with the organization now for 9 years. Chris?
Thanks, Ashley. Hey, I'm Chris Calderon. I'm our Chief Revenue Officer for the Difference Card, run our national sales and marketing practice, and excited to be introducing this monthly budget solution to you all today. Taylor, why don't you take us through the agenda?
Yeah. So we are excited to have you guys on today. First things first, we are going to talk about our difference guarantee. We're going to go through the solution and tell you exactly how it works. Next, we're going to talk about the reason you're all here today, the new monthly budget solution. This product lives under the difference guarantee, and we're going to walk you through exactly how it works. And then finally, we're going to talk to you about what makes a good fit for the monthly budget solution. Who would most benefit from this, and how do you quote the product with us? All right, so for those of you who are maybe not familiar with the Difference Card, I'm going to give you a little update on us here. We have been in the employee benefits business for about 20 years. We have been working as a TPA. We specialize in medical expense reimbursement plans, and that's how we help employers and their brokers create same or better benefits while saving money. We also have a guarantee. We're going to talk about that. And we work in all 50 states. So this is available to anyone who has joined us on the call. And if you look over here on our left-hand side, you'll see a couple of stats from 2023. This number of 18% is actually held strong for a very long time, but we did indeed save 18% again last year for our clients on average. In 2023, we were able to generate $239 million worth of savings to these employer groups. Really, really proud of that stat. And then finally, when we looked at our book of business, overall, we were able to reduce renewals for over 1,000 clients. So really impressed with what we were able to do in 2023 and excited for this solution. And I'm ready for you guys to see it and take it forward in 2024. So before we get started here, we're going to kick it off with a quick poll question. So this question is, what is your experience level with alternative funding solutions? What is alternative funding? Maybe you've never heard of it. Maybe you're vaguely familiar, or perhaps you use alternative funding all the time. Let me go ahead and start this poll question for you. Here we go. So yeah, go ahead and make your selection here. It's completely anonymous. We're just trying to get a good sense of who is on the call today. Give it just a couple more seconds. We've got almost 70% of our participants on here responding. All right, let's take a look at these results. So about 14% of you are not even sure what alternative funding is. 44% of you are vaguely familiar. And then we've got 42% who use it all the time to help their clients solve problems. So Chris, now that you have this knowledge, take it from here.
Yeah, Taylor, I think that's great understanding to just know how much our audience knows about the health insurance funding spectrum, because the majority of customers, especially in the small to mid-sized space, are still fully insured. I think 60% was the latest stat that I saw of customers that are fully insured in that mid-market section of the market that we operate in. So what we're going to focus on today is moving up the level to maybe level funded, MERP funded, or self-funded. These are the different types of alternative funding solutions that are out there. And I'm sure a lot of you have heard of level funded. Most of you that have worked with us before have heard of the MERP funding solution, the medical expense reimbursement plan. And that's really what we're going to focus on today, because the difference guarantee is a protective layer in that MERP funding strategy. And then the monthly budget solution that we're really going to spend some time on today, again, lives within the MERP strategy. And it's a way for our customers to more easily administer and get the maximum protection out of that MERP funding strategy. And that works on top of either a level funded or a fully insured underlying carrier plan. So you may be thinking, oh, I've gotten creative, I've gone level funded. Well, there's still another step that you can take even within the level funded world by going to this MERP funding solution using this strategy that we're going to talk a lot about today. So when the Difference Card first started writing business 20 years ago, we were helping customers save money across the country using the MERP strategy, buying these higher deductibles and funding back all the differences. But a common question we got was, well, this is great that you expect me to save 18%, and that's what your block of business says, but can you guarantee it? And we actually had a really big prospective customer we were working on for years as a big healthcare nonprofit. And they said to us, look, I love this, we will do it, but you need to be able to guarantee that we can save at least 10% because our budget is finite and we can't go over that level. We need you to put a cap on the risk transfer that's going on here. So we came up with this solution in 2018 called the Difference Guarantee, which does put a cap on the liability that the employer is ultimately taking on. So they're funding back those differences in deductibles and copays to a maximum point. And then we partner with Assurant, who's an A-rated carrier, and they pick up that excess liability claims over the Difference Guarantee point they actually will take on. And the way the normal product worked was that at the end of the year, we did all the accounting, and then we paid back the customer for any of those reimbursements that exceeded the Difference Guarantee amount. And that was a great solution, worked for so many of our customers. We've really had tremendous growth and seen a lot of new business because customers liked having that Difference Guarantee that we've had in place for the past 6 years now. But a lot of customers did ask us to go one step further and said, this is excellent. I love having this Difference Guarantee. It protects me on an annual basis, but I'm a nonprofit or I'm a public entity and I have a month-to-month budget that I need to stick to. So just in case, if there's this worst case scenario of a high utilizing month, well, that could be a problem for one of these nonprofit customers. So that was the feedback we were getting was, could you do something that made a fixed monthly budget? It was essentially just 1/12 of the annual Difference Guarantee that we were already proposing. So we've been working on this for a few years now. We had kind of a version 1 that came out a few years ago. And last year we did a soft launch of this monthly budget solution that we're going to focus on explaining today. And it does provide customers with a much simpler experience. Instead of them dealing with the variability of each month in terms of the actual claims, they just get to pay the level funded kind of fixed monthly amount. And it's based on the number of employees multiplied by the Difference Guarantee amount. So it's much simpler for them from an accounting perspective. It solves that budgeting problem that some of these nonprofits and public entities were telling us about. And it's a much better experience for the employer. So we're really excited to share more of the details about this monthly budget solution today. And I'm going to go through an example of how this works on a real customer. It's a case that we put in place for January 1st. I'll show you kind of the MERP card mechanics, and I'm going to pass it to Ashley to take you through the financials of how this actually worked. But here's an easy example of a customer that had a great benefit plan today. It's a no-brainer, right? $10 copay, 0 deductible. We know they were overpaying the carrier for that really, really rich platinum type plan design. So we worked with their consultant and said, let's buy this plan in the middle, the base plan that's got higher copays, higher deductible. We got about a 25% discount from the carrier to move to that base plan design. But they didn't want their employees to have to pay the higher copays and higher deductibles. So they put this card in place, the Difference Card MasterCard, which funded back the full copays, the full deductible, kept the ER benefit the same, kept the pharmacy benefit the same. And that way the members actually got an improved benefit, better benefits, but the overall price went down from an employer perspective. And this customer that we're going to show you used the monthly budget solution as a way to keep their monthly budget intact. So Ashley, why don't you take it from there and walk us through the detailed financial exhibit for this customer?
Perfect. Thanks, Chris. So as Chris had mentioned, this was a January 1st New York nonprofit that we wrote on the monthly budget solution. This group is actually getting a relatively favorable increase, but they came to us with a solution to improve benefits and then also reduce the fixed costs as they were overpaying health insurance premium to the carrier. So this group is with Blue Cross. Their current costs were about $3.2 million. If they had renewed as is on those current plans, their premium would have gone up about 4% to $3.3 million. So we worked with the broker. We went back to Blue Cross, priced out plans with higher copays and a higher deductible. We also added in the Difference Card service premium. So this brought their fixed cost down to $2.6 million at a 17% reduction. So what the revised fixed cost is essentially saying is that the group went back to Blue Cross. They bought a plan with higher copays, higher deductibles. They paid the Difference Card to administer, but not one single employee went in and had medical care throughout the year. Obviously, that's not going to happen. So we worked with our on-staff team of underwriters to come up with the claims projection here. So these costs are actually based off of maximum claims. So when we worked with the underwriters, gave the demographics of the group, maybe how many families are on the plan versus how many singles, what industry they're in. We looked at our book of business with over 20 years of data. We added back in about 340,000 of maximum claims. So what we're telling this group is that your revised max cost, a really worst case scenario, is a little bit over $3 million at a 7% reduction. And guaranteed savings to this client is $354,000. So this is really a worst case scenario. If the plan runs better than we expected and below the maximum, there's still potential for additional savings on the table. Looking at the plan designs, this group had a PPO as well as an EPO plan. The PPO plan had a majority of their enrollment, as Chris mentioned on the prior slide, very rich benefits today. So $10 office visit copays, $200 for emergency room, no deductible. Their current fixed costs were going up about 4% if they had renewed as is. We worked with the broker to price out the plan design in the middle. So this PPO plan here stayed with Blue Cross, same carrier here, $50.75 office visit copays, a $5,500 deductible. And by buying this plan, their fixed premium to Blue Cross reduces pretty significantly. So if they had renewed as is for this plan design alone, they were going to pay Blue Cross $2.9 million. With the $5,500 deductible, that decreases to $2.2 million. So there's savings there from a fixed cost perspective on their health insurance bill every single month. Then looking at the employees and the plan design of how this will all look and feel after the employer self-funds a portion of those copays and that deductible. If you look at the column all the way over to the right, the Difference Card plan design. So something that was important to this employer was to improve benefits. So we actually used a strategy to give employees no copay if they're going into the primary care for a sick visit or the specialist. We also kept all the other benefits the same. So during the open enrollment meetings, this is a great message to deliver to the employees that their fixed costs were reducing, they were staying with the same carrier, same doctor, same network, and they were going to improve benefits as well. If you look to the bottom right, you'll also see the Difference Card premium equivalent rates. And these are based off of maximum. So with this strategy and by using a MERP, employees can share in the cost of the claims as well as the administration of the plan. So these premium equivalent rates are a blended rate of the underlying carrier premium, the claims, and the admin. So if this employer was, say, doing an 80-20% split, for premium contributions for employees, they can use on the single plan, for example, this 1114 rate. On the next slide, we went through the EPO plan. So once again, same strategy, not as many people enrolled in this plan, just about 23. The existing plan had very rich benefits here. We also mirrored the plan design and the PPO of the new Blue Cross plan design here, the same $5,500 deductible. Still a great reduction in premium from Blue Cross here. And then the plan design all the way over to the right, that's what the employees will see. The premium equivalent rates, we provided 2 separate premium equivalent rates. So here are the rates the employers will use for premium contributions for employees enrolled in the EPO option. So we deal with a lot of groups and a lot of brokers that come to us saying, hey, my client is dealing with a difficult medical renewal. How can you help me reduce costs? And that's typically a one-year problem when they're looking at 20, 30% increases. I've even seen some 40% increases recently. But we don't want to just be a one-year Band-Aid on their health insurance strategy. We really want to be a multi-year cost-saving strategy. So this slide breaks down the effects of compounding. If you're reducing your fixed cost to the insurance carrier, even if you get an increase the following year, it's on a much lower number. So this slide here assumes a 9% renewal increase year over year. We looked at the total cost with the MERP plan versus if they stayed on their current path. And over a 5-year time span, we were expecting this group to save about $2.1 million by using the MERP strategy. We have 2 banking options. Today, we're mainly focusing on the monthly budget, but I did want to go through our traditional banking model and how we've set groups up for the past 20+ years. So we call this daily claims-based funding, or the pay-as-you-go model. So if you think about from an employer's perspective, as we looked through on the financial exhibit, they're going to pay the health insurance carrier a lot less in premium, sometimes upwards of 20% less in premium on a monthly basis. Most employers take those premium savings and they put them aside to help fund the claims as incurred. So in this model, claims are paid daily. So if I went into the doctor today, I swiped the card for $10, there's going to be about a 24 to 48 hour flow until those funds are drafted. So this model, claims are paid daily. There may be fluctuations depending on how the utilization pans out. So one month they may have 10,000 in claims, another month they have 20,000 in claims. But most employers choose this option to take advantage of the cash flow and having that money on their books until the claims are actually incurred. So with this, the client would keep the money in their account. We don't require an in-press balance. They would only fund the claims as employees were receiving medical services. And with this one, with the guarantee, there'd be an annual cap on the reimbursement. The next model that we're focusing on today is the monthly budget. So this is for a client who's really concerned about claim fluctuations from month to month. In the prior example I gave, there may be all different types of claims coming in, and the client doesn't really know how to forecast for those and how to keep the money on their books to pay the claims. So with the monthly budget, same type of arrangement, the client's saving money on the health insurance premium on a monthly basis. The client in this scenario would fund the claims at maximum on a monthly basis. So they're going to know what the fixed cost is going out every single month. That money is deposited into a bank account that claims are paid out of. From a client's perspective, this is almost a monthly cap on the claims versus an annual cap, where they know what their worst case scenario is. So say for an easy example, the monthly maximum claims are $10,000 a month, but the actual claims are $20,000 a month. At that point, the difference card takes on the risk and pays that additional delta. So for a client, they can really plan and forecast what their worst case scenario is on a monthly basis. If the client runs well and there's a surplus on the account, that money is in that account, at the end of the year, they actually get 100% of the surplus back if they run well. So there's also upside potential on this monthly budget strategy, similar to a level funded strategy. But typically, if you think about a level funded carrier, they're usually taking 30 to 50% of that surplus. With the difference card, they get 100% of that back. And then really the goal of this monthly budget is to make it easy to reconcile accounts, the billing, everything that we're doing. So here's an example of the monthly budget funding invoice, just one invoice from the difference card that they'll receive. It gives the breakdown of the service premium that we're charging, plus the monthly maximum claims that they're going to fund. Makes it really easy just to reconcile on their end. And then I'm going to pass it to Josh for the next poll question. Let's see who's paying attention here.
Yeah, thank you, Ashley. Yeah, who is paying attention? Because we already kind of alluded to this, and I'm going to expand a little more. So when you think about alternative funded solutions, what would your expectation for cost share be? Looks like the poll's open here. 50%. Does the level funded carrier keep 50%? Does the client get 50% of that back? Is it a 66% return, meaning maybe an administrator keeps a third of any reserves that are left over there? Or would you expect in a solution like this that it's the client's dollars, they go unused? If they're unused, they get 100% return at the end of the year. So let's see what we've got here.
Yeah, we'll give everyone just a couple more seconds to cast their vote, and then we'll share the results. All right, let's see what we've got here. So we've got 27% of the audience saying 50% is what they expect. Another 20% are saying 66%. And then we've got 53% of you who are paying attention a little bit and got that 100% surplus is returned to the client with the monthly budget solution.
Well, that's great. Thank you, Taylor, for running that. We would agree with the 53% of you that says that 100% share should come back. And we really think that that's a big value of this type product. And our clients have identified that as something that they really like. In addition to that 100% surplus share, you're still going to get the same great detailed reporting as far as utilization. So an employee has that card in their wallet, they're using it for doctor visits, they're using it at the ER, the urgent care, for prescriptions. Every time that card is used, or we're processing what maybe could be a manual claim coming directly from the carrier, we're going to report back on that to you, the broker, back directly to the client. So it gives you a lot of detail that maybe the carrier is not sharing with you today. Our clients really like that there's a separate reinsurance policy, again, backed by an A-rated division of Assurant. So, it's a contractual liability insurance policy that actually allows us to give that guarantee and to put a maximum spend on the group overall on a monthly basis and then on an annual basis. You still have the same ability to customize the plan design. So Chris walking us through that card swipe example, you saw that that group delivered some $0 copays, which typically isn't available from your fully insured carrier. So this product also still allows for that full customization of the plan design. And then the same great account management staff that you're used to working with today that leads the group and the client through starting at open enrollment and all the way through the year with ongoing support and questions that the employees may have. Our account executive team has been really involved in the development of this plan, hearing from the market, hearing from our clients, and working with us to really develop and to roll this out into a successful new product for the difference card. So here's the reporting package. You think there's still 12 or 13 different reports that you can pull from the broker portal, from the client portal. This is an example of, okay, the card's being used and the members are out there using difference card benefits. Where are they going? Now it's HIPAA compliance. You don't get the information that you shouldn't receive as far as diagnoses or things like that. But how are doctor visits higher utilized than emergency room, or is that vice versa? That's usually not good. How many urgent care visits are we experiencing versus going to an emergency room? So all of that little micro data that typically your fully insured carrier is not sharing with you, you can extract that from the difference card platform, and it just kind of takes that to the next level. It's useful mid-year to kind of identify trends. It's very useful at renewal to maybe reconfigure that plan, maybe beat up on the carrier a little bit if you're getting a high renewal and they're not sharing much information, but you do have utilization data from our side. So it's still available with this monthly budget product and even more, even my more financial reporting. So if we're paying 1/12 of our maximum claims every month, like Ashley showed us on the invoice, there's really no surprises for the employer from a month over month. They pay their carrier, they pay the difference card, and those rates are fixed for the year. The only thing that changes is fluctuations in enrollment, just like a change with the carrier would be. But those dollars for claims are now going into a bank account that they own that we would help establish upon implementation of the plan. But they've got insight into, okay, how much is going in and how much is coming out. So you've got a surplus or deficit report that you can reference each month. This is separate from that individual utilization report. This is more of how the plan is actually being financed for those claims. And you'll see on this slide, this is an actual client. It's a really large, over 1,000 lives nonprofit group that we wrote recently, and they ran hot. They had a higher claims year than what we expected. And thankfully, they had this reinsurance policy in place, and it protected them for almost $250,000 of additional claims that were utilized, but were not paid by the client. Assurant kicked in. They kicked in really at month 4 when they got into deficit, and then they carried them through the end of the year. So even though additional dollars were needed to fund the plan, it did not come off of the books from the nonprofit. So you're going to have insight into where those dollars are going and kind of where you're running. On the flip side of being in deficit, next slide, this is a school district that we have that they ran well. So we underwrote them with our kind of normal expectations for claims utilization, and they didn't use all of that. So there were over $50,000 left at the end of the year. It's their dollars that they paid in, set aside to pay those claims, and then went 100% back to them. So that guaranteed savings that they entered into initially actually increased because utilization was lower. So again, our clients are gravitating towards this because there's no surprises, still have that guarantee in place, and then you do have an opportunity to win if claims come in actually lower than our maximum. So let's talk about what's a good fit for the difference card in general. When should I engage with sales at differencecard.com? When should I call my senior consultant that I work with, whether it's a prospect or a current client that you may have? Well, it's really, it's mid-market. We usually get started 20, 25 lives and we go all the way up. So if that client's fully insured or level funded and they have a relatively rich level of benefits, probably a great candidate for the difference card. We're happy to look at any and every group and strategize with you. But in general, those are the clients that can really benefit from working with this medical expense reimbursement plan and take either the pay-as-you-go model or this monthly budget model. But again, you've got the ability to customize that plan design. You can save money by using this program. You can give a higher level of benefits maybe that you have today. And it's easy for us to quote. So in general, that's a good fit for the difference card MERP. When we look at what's a good fit, really nice fit for this monthly budget, well, it's available to every group. It's available to every market, every size group, and it's probably a proposal that your senior consultant will work up and just at least show you this as an option. But what we've seen from the marketplace is that certain groups kind of gravitate towards this. It's your nonprofits that maybe they're relying on outside funding and they have to account for that and be and have no surprises month over month. It's your municipalities and public sector groups, those groups that they have monthly budgeting constraints and they don't want to deal with, like Ashley talked about, what could be daily fluctuations in claims. So when you're engaging with us, we can show you both options. And we would expect that a lot of your clients and prospects are really going to like this option because it's just easier as far as understanding administration, bookkeeping, and then again, the ability to get 100% of that surplus back at the end of the year. So if you're interested in a group, hopefully your wheels are turning here and you're thinking of either a prospect or one of your current clients. It's maybe facing a tough renewal, or they want customized benefits, or they need they need savings off of the table. How do you quote? Well, it's just as easy as it's always been. Reach out to your senior consultant. If you're new to the difference card, you can contact us at sales@differencecard.com and we'll get you hooked up with who's in your region. But we don't need a ton of information to produce a quote. And that's how a lot of groups get started, with very limited information. ultimately, to solidify a quote, we're going to need the rates, current rates, usually doing this within the renewal. So that renewal packet that has the current renewal rates. We need the plan design. So what does the client offer currently as far as their members and what they can enroll in? And then tier counts, not a full census. We don't need demographic, deep demographic information. Just tell us how many employee only versus families that you have on the plan. And then if there is any other alternative funded solution currently in place, like an HRA, we're going to ask for that information as well too. So you can usually produce a quote in 2 to 5 business days, depending on the amount of information that you have. But reach out to us. We love to strategize. We love to work with you. Again, even if it's with limited information, to give you some sort of proposal from the difference card and get the ball rolling. So I've seen the chat going here. I'm going to wrap up, and I think I'm going to pass it now back to Chris and Taylor, and maybe address some of the questions that we've had. Thank you, everyone.
Yeah, thanks, Josh. And it does look like we've got a few questions, some in the Q&A, some in the chat. So why don't we try to get through as many of these questions as possible. If you do have a question that you've been thinking about, just pop it into the Q&A, probably the easiest way for us to respond to them. But first one I see is about the deficit versus the surplus and how does that affect the second year? Well, Ashley showed you the 5-year chart and how this affects the renewal, right? If a group is running hot, well, on one hand, we're taking away some of those claims from the carrier, so you're not going to get hit with the trend that you may have been hit with if those were carrier-paid claims, right? So you're taking those claims out of the carrier-paid bucket, putting them into the difference card paid bucket. So from a carrier perspective, it should help you longer term because you're going to get a compounded number on a lower starting point. If there is a deficit, it probably means the group ran higher than what we expected. And there is a experience rated factor that's used at renewal time. It depends on the size of the case. If it's a small group that is not credible, well, then it's not going to affect them that much at all because the block of business, we've got a very large block of business, that piece of it is going to subsidize their renewal. If it's a larger group that is experience rated, then that higher claim utilization may affect the renewal for that second year. So there is a factor of how the group actually runs when we come up with the difference guarantee renewal for those future years. That's a good question. Next one I saw was about an existing customer. Let's say it's a current difference card customer, and maybe they are struggling with the accounting of our solution and they are looking for an easier way. Well, we are converting some customers to the monthly budget solution, but that's on a case-by-case basis, and you've really got to work with your account executive that you're assigned to. So it would most likely happen upon renewal time to make sure it's done in a seamless manner. But we are definitely in the midst of moving some groups that have voiced concerns saying, look, I need a solution that gives me a fixed monthly payment system, and we are transitioning them to this. So it's possible, just work with your account executive that's already assigned to that group. But I think I saw a question about HSAs in the chat. So the question was, how does the difference card and monthly budget tie into the HSA plan design? And they're really kind of, the monthly budget side is separate from the HSA. HSA is the underlying plan. And we have a lot of groups that buy a high deductible health plan that's a qualified high deductible health plan. And they might want to keep it as a qualified plan, but they also want to use the difference card MERP. And you can put the two together. So the way it works is the first part of the plan has to be paid by the employee. You've got to keep that first deductible open so that it's still a qualified plan. So let's say the employee pays the first $2,000 of a $5,000 deductible. That's employee paid. And then the MERP, the difference card reimbursements, start to kick in for the second $3,000. And that way you can still have a qualified plan. You can still contribute pre-tax to a health savings account. Difference card does the administration for many of our customers' health savings accounts. So we'll help you with the banking angle of that. You can invest those funds. There's a lot of advantages of an HSA, and the two do work very well together. Just need to make sure it's stacked in the right way so that's still a qualified plan. All right, I think that answered the question in the Q&A as well. Taylor, anything I'm missing? Any other questions that you see?
It looks like we had just one more here pop in over in the chat. Do you see any there, Chris?
Oh, the surplus. Yeah, this is a good question. So is the surplus available even upon non-renewal of the difference card? So I do know that there are certain carriers out there that they keep the surplus if you do not renew. It's kind of a ball and chain to keep you with them. That's not the way we operate. You do get the surplus even if you do not renew with the difference card. We hope you do, right? We're gonna do everything we can to deliver excellent service and make sure that you do renew, but we're not going to hold on to the surplus. That is the customer's money. So even if you choose to not renew with the difference card, you will still get that surplus back at 100%.